CPI comes in below expectations this month. Starbucks has a new CEO, and volatility returned to the market last week. All this and thoughts around the tightening presidential election on this episode of Investment Insights from Opal Capital. Thanks for tuning in to this episode of Investment Insights. My name is Jay Coulter. Joining me, as always, Austin Graff and Adam Mueller. Our first topic, CPI data came in at 2.9% today, year over year. That is below the 3% expectations. Check out this post from Charlie Bilello on X this morning. Notice transportation still up over 8%. Shelter still up over 5%. Electricity still up almost 5%. But on the other end of the spectrum, used cars down 10.9%. Gasoline down 2%. New cars down 1%. Gentlemen, what do you make of the inflation data? Adam, I'll start with you.
Yeah, look, I think I'm glad you kind of broke it down into some components, because I think the real key to this is how is it impacting kind of the average U.S. consumer. And with food at, what was it, 1-ish% and fuel down, I think those are the two key things from the perspective of what the day-to-day life of a consumer, which is going to make them feel better, which is going to impact their expectations of inflation going forward, which can have a positive impact on the economy. But overall, the good thing here is that it wasn't a bad print, that it didn't miss, because the market is all bulled up, pun intended, on a rate cuts coming. And now the risk is, what if the rate cuts, it doesn't come or isn't as much as people want, or doesn't happen as fast as people want? And not just this first potential cut in September, but sort of the cadence over the next few months. We've now set ourselves up that if the Fed doesn't deliver on what the market thinks, we'll have increased volatility and perhaps another sell-off. And let's not forget that a week ago, the sky was falling down. The market was 8-10% fall in 3 or 4 trading days, and we've clawed all of that back, and now everything's rosy again. People that were about to jump off a ledge are now, booking vacation homes for the end of August because they're rich again.
Well, we'll definitely dive into the volatility of last week. Austin, what are your thoughts on this CPI print?
I think it's interesting, and it's interesting how it was broken down by Charlie, because when you look at the actual data, some of the stickiest inflation is in areas of the economy or in products that people need for day-to-day life. When you look at some of the capital goods like used cars and new cars being down the most, that's definitely being driven by interest rates. But when you think about electricity and food and dining out and shelter and those things that are continuing to remain relatively sticky, you wonder if rate reductions from the Fed might cause additional problems in the economy that don't necessarily show up from the top-down data. So I think it does create somewhat of a conundrum for the Fed, as the market was demanding a 50 basis point cut last week. It does seem like that 50 basis points would be irrational at this stage, because you might be pushing up the prices on some of the day-to-day necessities more than everything else, even if it doesn't show up in the broad data.
I also think this creates somewhat of a paradox. If the Fed does come out and start lowering interest rates, that presents the potential problem of future inflation. It's spiking back up. As portfolio managers, how do you address this? Adam, I'll start with you.
Well, look, I think it depends. I think it's premature to sort of speculate on what could happen. And I think the real question is how fast does the Fed cut? How careful are they? And remember, on the upside, it was one of the fastest tightening cycles in history. That doesn't necessarily mean it's going to be one of the fastest loosening cycles in history. So, look, there's always a risk that macro data can change, and cutting rates leading to future inflation, I think, is, inflation is always a macro risk that one should think about. But I don't think because you're in a loosening cycle, you need to lose sleep over future inflation.
Austin?
I think from a portfolio's perspective, the best hedge against inflation is high quality equities that have pricing power. Another great hedge against inflation is commodities exposure. You have to be a little bit more cautious on that commodities exposure in a shrinking economy. However, when we think about putting portfolios together, we're thinking more about being in those high quality equities at reasonable prices, and also having a slight lean towards commodities, because if inflation does spike back up, I think that's a key kind of risk that most people don't necessarily. It's like the hidden risk in many portfolios that we try to account for as portfolio managers.
It might be worth mentioning that, the way that we talk about sort of macro indicators and macro data and things like inflation on the podcast, if this is all you listen to with respect to kind of our investing style and portfolio management, it probably sounds like we turn over the portfolio 5 times a day. The reality is, we talk about this stuff because it's important and it doesn't move the overall market, but that's a very short-term phenomena. And the reality is, we talk about it, we think about it, but we rarely do anything about it because we like what we own, and we're not owning it for this week or this month. We're owning it for a much longer time horizon. And so a lot of this stuff is short-term noise.
Well said, Adam. Next topic. Yesterday's headline news was that Starbucks got a new CEO in Brian Niccol. The stock went up 24% on the news. What's your take on star CEOs and this Starbucks news? Austin, we'll start with you.
Well, as holders of Starbucks, we're really excited about the fact that Brian's coming on board, and the market reaction was positive. I'm not really sure if this is more of a if it's more the market saying we really like the new CEO, or if it's more the market saying we really dislike the prior CEO. And so all I could say is I think that CEOs do have a significant impact, especially supposedly visionary CEOs, which, Brian Niccol is considered a visionary CEO because of what he was able to do at both Taco Bell and Chipotle. And I think the market's hoping that he can do similar things at Starbucks, focusing on, bringing traffic back to stores, and also digitization, which it does seem like Starbucks has fallen behind on. So as general, I don't like to get super excited about one individual influencing a company too much. In this situation, it does seem relatively unique, as he has a track record at very similar companies of very successful leadership on both a strategic perspective and a capital allocation perspective.
Adam?
Yeah, I mean, I guess Starbucks is going to start charging extra for guacamole, but look, I think it sucks to get fired, but it must really suck when you get fired and then the market says, "Oh, by the way, you were a negative $20 billion impact on this company." And gosh, that's it reminded me of when Steve Ballmer stepped down from Microsoft and the stock was up 10% or something on that day, which was a huge change in the market capitalization. And to Austin's point, I agree. Is it because everyone loves the new CEO or disliked the old CEO? The reality was that the company was struggling and decided to make a change. But I will say this: like it's when there's a change at the top and the market cap changes that much, there is something wrong. And I look at the board of directors because their single most important function is hiring and firing the CEO. So if they make a change and the market cap changes that much, then they've had their eye off the ball. Something has gone wrong. Now, it could just be that the old CEO was a mishire, and that happens sometimes. And you hire a CEO, you give them big compensation packages, and once they're hired, I guess you have to give them some time to see if they can do it. But someone should get fired when your stock reacts that positively to a new CEO, and it should be a board member that says, "Gosh, we didn't do our jobs."
So, Adam, this kind of speaks to the activism that we're seeing across the board now. Are we in a new cyclicality where we're going to see more shareholder activism, and where could it manifest itself?
It does, and look, maybe it's just in the headlines, but it does feel over the last few months that some activists have taken some big positions in big companies and started to exert some influence. And Starbucks is an example of that, where I think there is 2 activists that have come in, one very recently, they may not have even had an impact on this CEO change, but may have very well just sold their position yesterday. Who knows? And that's a great outcome. And I think, like to my earlier comment about the function of the board of directors, some of these activists are very positive influences because they come in and they tell the board, "You guys haven't been doing your job, and here are our ideas on what you should have done." and maybe make the change. But you've seen it in Starbucks. I think Southwest is. I think an activist just launched a slate of directors, pushing Southwest to make some changes and do some things. And maybe we're in that part of the cycle where activists are seeing some, let's call them fallen angels. And a company like Starbucks, it's a great brand. Everyone's heard of it. The company has struggled, so the stock price has lagged. It's a great opportunity for activists, and I wonder if we're going to see more over the next few months.
I wouldn't be surprised to see more of these activist campaigns when you see what's going on in the broader market, where you have 7 to 10 names that are driving returns. It's very easy for a hedge fund or an activist to come in and say, hey, you've trailed the market by 10, 15, 20% because either you aren't executing or one reason or another. And they also know that if they come in and start shaking things up, it tends to drive returns back to kind of market returns. There's a lot of opportunity underneath the surface, underneath those top 7 names. And I think that's why we're seeing more activism in bigger names rather than it being, small and mid-cap names, which is a more traditional activist target.
Next topic. Volatility returned to the markets over the past couple of weeks, and now we're sitting back at or touching all-time highs. It's got to be frustrating for investors who are emotional with their decision-making process. Tell me, Adam, how do you look at the volatility we've experienced the past couple of weeks?
Yeah, I mean, I look at it and I think there's probably more coming. And if you were scrambling to buy, insurance via the options market on your portfolios when the market was cratering for those few days, a week or 10 days ago, you should be buying it now, right? Buy it when volatility is a little, when the when the VIX is a little lower, so option prices are a little more reasonable. When there's not a cloud in the sky, because when volatility spikes like that, it doesn't. With everything going on in the world, with the situation in the Middle East, with the situation in Eastern Europe, with the U.S. presidential election, that's a very, very close race. There are a lot of things and a lot of headline risks that can spike volatility. So if we're in this brief moment where we had this spike and now it's settled down a bit, now's the time to buy your fire insurance when your house isn't on fire.
Austin? Yeah, I think that the market seems to be a bit more on the side of fear than on greed right now. So if basically investors are looking for things that could be wrong with the market, and that doesn't mean that it's going to go straight down, but it means that whenever there's a slight shot, or whenever there's a slight issue, it turns into a much bigger issue in the market, because people are fearing that it's going to turn into the worst. We're seeing a lot of movement in macro data, which I think is preventing the market from being as calm as it has been historically. And the rate change in Japan is a good indicator, where they, for the first time in a long time, started increasing rates, and all of a sudden there was this unraveling that nobody saw coming. It wouldn't be surprising to have more of that as we see the Fed going from, raising rates to holding rates high to all of a sudden they're going to be reducing rates. There's likely going to be some casualties to that move. It's unknown where they're going to be right now, but it likely leads to more volatility going forward.
Final topic for this show. The presidential race is tightening according to a lot of the polls that have come out the last several weeks. I generally have a little bit of mistrust in political polls, as if you understand basic statistics, there's always some massaging in there. But generally speaking, it looks like it's a tight race. Adam, as a portfolio manager, how does this influence how you look at the markets and portfolios?
It doesn't. And I think from a portfolio management standpoint, a tight race is great. A race that on election night, everyone's watching their TVs, wondering who's going to win, I think is actually sort of helpful, because what we know is that it doesn't make a lot of difference either way anyway. And we're going to look through it from a portfolio management standpoint. So not having anyone know what's going to happen, it may be on the margin, it adds a little bit of volatility, but I think it's a nice way to just kind of move through the cycle without the Trump trade is in favor, but oh no, now it's got to unwind because he's not going to win, and now he's going to win, and you're getting rid of all of that and just having some sort of weighted average kind of view in the market. Seems like it could be maybe a healthier way to go, but I don't know that it matters much either way.
Austin?
I think it's a great lesson in not getting too excited about uncertainties. And so I think, a couple weeks ago, people thought that Trump was going to win, and you started to see the Trump beneficiaries, and people come out with a Trump basket of stocks that are going to exceed the market when he gets elected president. And then all of a sudden there's a change, right? That very few people could have predicted. And those Trump trades started to unwind. It's kind of like what we saw happen when the Japanese carry trade started to unwind, and we saw a number of names do poorly, and then all of a sudden they're not doing poorly. So instead of like being reactionary and jumping onto things that one can't control, it makes sense just to sit back and think about where the risks and rewards are in the market and focus on the things that are controllable, which are kind of diversification and making sure that you're not overweight towards, whether it be the Trump trade or the Harris trade or the Japanese yen, whatever you want to be. You just don't want to be kind of going all in on one thing.
Look, the one presidential outcome that could really, shake the markets is if RFK Jr. wins. And I don't know who's out there who's bought a bear carcass demantling machine, but that's probably the trade.
With that, we're going to wrap up this podcast. We will be talking about politics and its impact on portfolios, I'm sure, over the next 2.5 months leading up to the election. To learn more about Opal Capital, please visit opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.